Okay, well, welcome everyone to this full FX webinar on crypto and foreign exchange, where the two spaces meet. We are really happy that you have joined us, guys. Thank you so much for your time. But just a quick reminder before we get started, please make sure you mute yourselves to not disrupt this next half an hour, where we will be talking about stablecoins and some other areas as well. But really, the focus is on how today crypto and foreign exchange markets interact. My name is Eva Szalay. I'm a contributing editor to the Full FX, and I'll be moderating today's session. And just to kick us off, I'd love to ask our wonderful panelists to just briefly introduce yourselves and your company and tell me where you're coming at this topic from. Cass, maybe we could start with you, please.
Thanks, Eva, for having me here this morning. Cassandra Cox at LMAX Digital. LMAX Digital is the cryptocurrency trading arm of LMAX Group. LMAX Group is a UK headquartered fintech that a lot of the FX participants here today will be familiar with because of our long track record in running FX liquidity pools. Basically, we've taken that know-how and taken it over into the crypto world, and we are now also running matching engines and liquidity pools in crypto. So we're very well placed to understand the intersections between TradFi and DeFi and how the whole world of stablecoins is playing out as both a disruptor and an innovator in the space.
Thank you so much. You're a kind of living, breathing intersection of the topic.
We are indeed.
Thank you. Varun, can we have your intro, please?
Sure. Hi, everyone. I'm Varun Paul. I'm Senior Director for Financial Markets at Fireblocks. I've been here for 3 years, and prior to this, I spent most of my career at the Bank of England, so I come with that angle and that background. Fireblocks is a digital asset technology platform that enables every business to engage in digital assets, starting with the ability to custody and hold and transfer those digital assets securely and easily. And as it's built on that technology, it's enabled broader use cases, including tokenization of assets on blockchains, as well as payments on blockchains. Very happy to be here today.
Thank you guys so much. So let's kind of kick off with the meat of the discussion. Where do you see an intersection today? You know, where are the areas where the two spaces are cooperating, or maybe one is nudging the other one towards changing a little bit? And I mean examples apart from conferences, because every crypto conference I go to nowadays, it's full of foreign exchange people. So there must be something out there. Who would like to kick off?
Maybe I'll kick off, Eva, with, I mean, if I back out from LMAX's point of view, which will kind of be a little bit complementary to Varun's at Fireblocks, because we're very much talking to the sort of front office trading part of the ecosystem. And what I will say is, as soon as we called them cryptocurrencies, I think every FX desk around the world went, yes, these are ours, because having a brand new product that you can bring into your trading sphere and a new source of alpha is, hardly ever comes. And when it does, with such a kind of volatility parameter, it's pretty interesting. So one thing I will say is the way FX and crypto really interact beyond just the names is just some of the broader market structure. A lot of that operates initially from the fact that FX is a true global market. There is no one global regulator. We work across a lot of different parameters and different time zones. We have been 24/5 since the beginning. So that kind of continuous follow the sun market making that is required in crypto is absolutely second nature to FX desks. So that's kind of one way where the cryptocurrency side of the business does look as though it's well suited to sit inside an FX business. And our experience to date is not that all firms are choosing it to do it that way, but that in a lot of the sell side firms, increasingly crypto is being embedded into the FX trading desks. What I will say is on the asset management side, it is being distinctly put aside as a separate product with a separate alpha return. And that's purely just because in their world, obviously they would need to rewrite fund documents. So having it embedded quite so quickly is a little bit more difficult. But that's kind of on the trading side, we're seeing a really a very good overlap of a lot of the systems you can use. We all still talk on API fix. We're very much building an infrastructure that FX people know and understand. And that's kind of one area where we see FX and crypto interacting initially. We can talk about some of the others around the macro and the economic side, but maybe I'll let Varun see if he's got any comments on the custody side.
Yeah, well, maybe I'll give a slightly higher level viewpoint actually. So, which is that for all the global market that crypto is, we see most cryptocurrencies priced predominantly in dollars. And it's really interesting to see how different regimes around the world are stepping up to try and get more assets priced in local currencies. But as things stand today, there is a real market there to step into, not least because there are technologies out there. If I think about the real DeFi end of the spectrum, there are technologies like automated market makers, which would have a technology, a smart contract, deliver all that FX without any intermediaries involved. But the truth is that today there's a real role for FX players with the real market depth to provide that interchange. And we see many stablecoins, and I'm sure we'll talk more about this in a minute, but stablecoins and the desire to be able to receive stablecoins and take part in FX is a really important part when we get to the utility of this market and moving money across borders.
I mean, it's so interesting that, like, I was having a conversation recently at an FX conference, no, at a crypto conference with an ex-FX guy about this subject, and he said, you know, we see clients like, you know, big corporates who are starting to really look at things like stablecoins, and as a result of them using stablecoins, essentially their FX counterparties are losing business at this stage. So can we just sort of unpack stablecoins a little bit? How relevant are they for someone who's trading FX at the moment? What should they know about it? What could it do to disrupt their business? Varun, do you want to go maybe first?
Happy to. So I think stablecoins, if you're looking at this from a crypto vantage point, you'd say that stablecoins is the killer app for blockchains at the moment. It's the ability to move value, gives you the immediate ability to move value across blockchains while preserving the volatility, preserving stability of that token. So we've seen a rapid increase in demand for stablecoins, which are performing much better as payment tokens than your traditional cryptocurrencies like Bitcoin. Now, what that means is, in reality, we've seen people using these as end-to-end payments from parts of the world, from developed parts of the world to developing parts of the world for remittances, for example. We're also seeing corporates engaging in stablecoins to move funds all around the world at a much faster rate than they can do in the traditional system using the correspondent banking network. So we see this real opportunity in the utility of stablecoins. But as I say, there's a role for the interchange there, because at either end of this movement of value, you want it to land, you want it to on-ramp, as it were, in one currency and off-ramp in the other currency. So there's a role for the FX at either end, in fact, because we often see US dollar, USDC, US dollar stablecoins as the movement, the stablecoin leg in the middle, moving the value across borders. But actually, the source currency and the destination currency could be anything, and it could be moving. We could go across 3 different currencies to land to the destination. But maybe Cassie wants to add something to that.
I mean, I think you just sort of draw on the key point there. At the moment, the stablecoin environment is completely dominated by US dollars. There are some non-dollar stablecoins out there, but when we look at Tether at about 160 billion and Circle at 60 billion, that's mostly in USDT and USDC. So at this point in time, as a true disruptor for FX, I think we've still got a fair way to go, because what it more to me looks like is a disruptor for US dollar payments at this stage. I think we will evolve. I think the FX conversations will move forward, but it's kind of very relevant to remember that these are very fast moving representations of cash. And trying to turn my volume up, responding to that. And what I actually, what is one of the things that we need to consider is that, typically in banks, we don't send $1 for $1. You know, the world doesn't move $1 for $1. We operate on a system of netting, compressing, and only really paying out what we absolutely have to, because moving capital around is really quite intensive. So I think for an institutional use case of stable coins, we will need to look at it a different way, because when I look at the FX markets, we know that the bulk of FX is actually done in FX swaps. That is a derivative product of the cash. Now, a stable coin doesn't solve the problem for an FX swap because it's solving at atomic settlement level. Stable coins are there to represent and to improve what happens in the spot markets. In terms of derivative markets, what stable coins can do there is act as a much faster form of collateral for underpinning some of these derivative contracts. But I do think it's important when you're looking at it from an FX desk point of view, is they don't disrupt pretty much 50% of what we're doing, because if you want to do an FX swap, the stable coin's not really playing a huge role in that. You know, if I look forward to the future, it might be that we don't need FX swaps if we're all doing atomic settlement. But the reality is, you know, they do provide a value hedge against portfolios and other kind of vehicles. So, you know, when I sort of look at it, I think it's important to remember where we are on the journey and where we could end up. And I think at the moment, stable coins are still trying to find their way. I think the fact that non-dollar stable coins haven't grown as quickly is kind of indicative of the fact that local currency liquidity in the FX markets is kind of, aside from the big G7s, is kind of a specialized area. You know, you normally need onshore banks, you're layered up with local regulation, and disrupting those markets is going to just be a little bit harder. So the evolution of, say, a Korean stable coin versus a dollar stable coin will require quite a different kind of regulatory footprint to be able to truly start to unlock some of the value that we're seeing.
But also maybe some of the use cases, right? I mean, I don't mean to be at all, you know, offensive to the people who want to hold Korean won, but it's probably a smaller percentage of the population than who want to hold dollars as well, right? So there is, you know, probably like a sort of demand side there as well. I mean, it's going to be, and just before we kind of move on, you know, one of you mentioned the idea that, you know, the dollar dominance story, and you know, there aren't sort of new competitors. The euro, for example, sometimes it was talked about that it could stablecoins could open up a way for other currencies to become more relevant on the global stage. So do you guys think that's going to happen? Is that something that you see developing at all?
I'm happy to jump in. So I think if you think that stablecoins will enable payments in domestic markets, people will start paying for goods and services at some point using a digital version of money, then yes, absolutely. Because people don't want their economies denominated in other currencies unless they've had to do so for stability reasons. And so I think regulators around the world see that as a really important role to play to provide a local currency market in a stable coin and or different versions of money. So it's not just about stable coins, but it's spread out to tokenized deposits issued by banks or central bank digital currencies issued by central banks. But yes, I think it's very important.
Yeah, I think I agree there, Varun. I think we're going to have a few different forms of money in each economy. I do think central banks will try to keep a very tight lid on their the stable coins issued in each currency. When I look at the fact that Europe moved first with markets in crypto asset regulation, it's kind of surprising that we haven't seen the euro adopted more. It was, you know, we had a really strong regulatory framework, which potentially should allow people to be able to build there. But in essence, the crypto market, which at this point is still the biggest users of stable coins, is very much a dollar denominated market. I think as stable coins, Eva, as you alluded to, as they move through the system and into corporate treasuries and downstream, you will see the need for other currencies. But as we said, stable coins are a killer crypto app. They're highly used in crypto. You cannot access DeFi without stable coins. And DeFi is a very, very important part of the crypto ecosystem and really where we see the future of finance being built. However, at the moment, stablecoin use outside of the crypto ecosystem, I would say, is still very much at early days. I think there are some disruptions in the payments area, but I still think widespread adoption, it is still only just at the beginning. Stripe has only just started. You know, we're only seeing some non-crypto firms really begin to move into the space. So I think the dollarization is probably an impact at the moment and will lessen over time.
Thanks, guys. I mean, in terms of, you mentioned DeFi, Cass, and earlier, you know, at the beginning of the discussion, you mentioned the similarities and the natural fit with crypto and currencies. So is there anything from a trading perspective that you think FX should look at in DeFi? And you mentioned, you know, DeFi is the future of where future of finance is being built. Can you put a bit of flesh on those bones for us, please?
Hey, what I would say, what DeFi is allowing, what it's not really DeFi, what the tokenization of real world assets and assets will allow us to do is to more seamlessly trade anything against anything, because when a tokenized version of one asset is sitting on the same blockchain as a tokenized version of another asset, you remove a lot of the friction between exchanging those two directly in value. And the future of finance, as LMAX sees it, is a world where it's a true cross-asset marketplace. And we're working every day towards building this, where you've got a frictionless transfer of value of any asset against any asset. And the sort of ideal is that you don't have to go Apple stock into dollars, then into Bitcoin. You know, for example, you would just trade Bitcoin against Apple stock, or Apple stock against airtime minutes on your mobile phone. You know, we're tokenizing anything of value, and we can gradually move towards this world where anything can be exchanged in value, as long as the tokens are there and as long as a value can be derived. So it's, you know, I'm not saying that happens day one, but if you look forward to where it is, that is kind of the trajectory of where finance is going. We're seeing it already in the retail space. Increasingly, people are able to trade, you know, stocks 24/7, even though they're not listed 24/7. We're coming up with solutions. And I think tokenizing assets just allows us to do that in a much more uniformed and programmable way. I mean, as Varun said, smart contracting is very important in the future of finance, and that's what DeFi is there for. And this is all underpinned by the fact that you need digital money. So stable coins really are the sort of fuel for this fire.
Varun, do you have any thoughts on tokenization? And I guess, you know, this idea that, well, you know, FX people should like pay attention now if this is all going to get tokenized very soon.
Yeah, look, I think it's very clear to me that the things have shifted in the past 6 months in this space. And in particular, we've seen US banks getting more involved and US regulators pushing regulators around the world to think harder about how you make use of this technology. The vision we've all had in the industry for some time is that you can tokenize anything and you can enable fractionalization and broader reach to any number of participants around the world and eliminate some of these frictions we see in the traditional financial system. Obviously, those frictions are minimal in the FX part of the ecosystem, but everywhere else you look, there are margins to be eaten away, and there is a lot of automation you can create with this kind of programmability. Whether it is faster transactions for shorter term borrowing like repo markets, we're seeing that moves in that direction in the digital asset ecosystem today. We will see in time action in the bond markets as well, where there are spreads to be reduced by making use of this technology and automating some of the flows and automating some of the life cycle events that you see. So I think tokenization certainly has that opportunity, and I think we're seeing a real march towards that. And it is starting absolutely with money on chain, stablecoins, to enable some of this. Next is the money market funds that are coming on chain, enabling a lot more mobility of capital, collateral. And we will see a march on towards the rest of the financial system over time. It's not happening overnight, but it's certainly heading in the right direction.
So is on-chain FX trading something that you think will happen in the next 5 years?
I mean, you can on-trade. I mean, anything that's tokenized you can trade, and trading on chain for FX, I 100% think will happen. You can do it today. LMAX already has the technology to allow you to trade FX on chain. We very much believe, though, that we shouldn't really throw everything that we built away. You know, if we remember back, and I know the FX people will be here, when we used to go for call outs on our Reuters machines, and, you know, we traded FX in a highly manual way on phones and all kinds of different matters. What has happened with the electronification of FX has led up to a much faster market, a much more efficient market in terms of price discovery and in terms of the ability to absorb news. We have a very efficient marketplace in FX now. We have also, I guess we've become one of the fastest markets out there. You know, the latency in FX, and actually in any of the developed markets, is really low. And we've all spent a number of years finessing the technology behind that. LMAX's point of view, being an operator of a very low latency trading venue, is you don't need to throw everything away to get what comes with DeFi. DeFi is it's about protection. It's about limiting counterparty risk, because the way in which the smart contracts operate and the decentralization of that counterparty risk can actually add some resilience to the system. So there are certain parts of DeFi that we really embrace. However, in terms of finessing your execution, I think it will be hard to beat what we've built in traditional finance. What we see when you look in DeFi on Uniswap with AMMs is that there are some flaws. I mean, they're absolutely great areas to trade at the moment if you're looking for some arbitrage opportunities and sources of alpha. And particularly maybe some of the staking pools are very interested in DeFi. But when I look at it purely from an exchange of value point of view, I still see it's a little bit behind what we have in TradFi. So I think we're still going to see a merge of those two worlds, because the efficiency we have in TradFi will be improved by some of the on-chain technology, and we don't need to actually scrap everything we've already built. You know, it's taken quite a number of years to get it this fast. There's no point getting rid of it now.
Yeah, I just want to add, I mean, Cassandra's absolutely right. The FX market the latency in that market is far better than you're going to get on a blockchain. So the blockchain is not going to solve or improve that. But what it can do is expand the market reach potentially to other participants. That's one of the things that we'd see. And as I say, a bit more driver of end-to-end movement of value. And so certainly not speed, but a really interesting related point is this, that in a world where Cassandra talked about treasuries, talked about corporate treasuries moving value across borders. And if that is the driver of at least some portion of FX demand in the world, we are seeing an increased appetite to do that on blockchains. And for a couple of reasons. It is not more cost effective today. If you look at the unit FX exchange, you're not going to get the same FX rates, and you're not going to get the same market depth unless you go to the same FX providers you can today. But the thing that you get is the instant transaction and the instant movement of value. So actually your exposure to that FX rate is much shorter. We're talking minutes rather than days or weeks, and the fees are much lower. So if you look at the underlying driver for people moving value across blockchains and doing that FX on chain, it is because they're shortening that settlement time and the movement of value. And as a result, right now, today, there are corporates around the world who are very willing to take a worse FX rate because they're saving on liquidity costs. And so even though it is more expensive, they're saving on time. And that's a really important point to note, that these different dimensions of time. Obviously, the FX rates are so super powerful and super deep markets, but the end user wants that immediacy of value. And so super important to remember that.
Thank you both so much. Just a quick shout out to the audience. Please feel free to send in questions. We do have one question, Varun, that's to you about the capital intensive nature of stable coins. For, you know, are there better solutions than stable coins for payments?
Yeah, it's a very good point. So let me try not to go too deep here, but stablecoins super powerful as for the end user who wants to move value across chains. They actually happen to be very good for an issuer as well. So Circle and Tether, two of the largest issuers we mentioned earlier, have made huge revenues, huge profits by simply taking on that money and investing it in US Treasuries. And because they're stablecoin issuers, they don't have to pay any of that yield out to customers. So they're making a 5% spread on $160 billion, as Cassandra mentioned, which is a pretty good play right now. It won't always persist, but that's very good. You could ask yourself, as we've heard US banks stepping into this space, whether all US banks should suddenly pivot to this model because it's highly profitable. But the truth is that 5% is nowhere nearly the rate of return that a bank can make when it is able to engage in fractional reserves. And so there is a better model out there, and it is the traditional banking model, which allows them to have fractional backing and hold deposits, and then use that to make a range, a whole portfolio of bets in the market, and they are able to earn much higher yields. So there is a limiting factor here that will mean stablecoins won't suddenly take over the whole world, because a tokenized deposit will have the same features on chain as a stablecoin, but will have a more capital efficient outcome. And that's why we've seen JP Morgan dollar emerge as an alternative to the stablecoin ecosystem. And then, as we mentioned a couple of times here, there is also central bank money, and central bank money is lower risk still and can solve some of these problems. The real challenge, the real reason why stablecoins will still persist, though, is that stablecoins can move as bearer instruments, as I keep saying, end to end. So you don't need to, you can go outside of the ecosystem, outside of the ring fence, the perimeter of the individual bank or the perimeter of the individual central bank jurisdiction, and you can send money end to end around the world. And so I believe stablecoins will always have a role to play in that moving values across borders beyond what you can do with a bank or a central bank money.
Yeah, absolutely. The permissioned nature of what banks will do will restrict some of the use cases that stablecoins already fulfill today. I think, tokenized deposits operating on DeFi dApps is probably not going to happen in the short term. It will take a while until we see that. Although I do believe the SocGen stablecoins are actually permissionless now because they've tried to embrace that as well. However, there still remains kind of key hurdles for the two worlds to merge. And I do think it's interesting because I think institutional clients will be a bit more hesitant about giving up all the yield. And so we will see we've seen announcements from CME partnering with Google to do some kind of form of tokenized deposits as well. And I think in the short term, we get a lot more than less, and we will probably end up with a big array of issuers operating, as Varun said, in their networks, and those networks will be closed, and you'll have to be a client to come into them. And then how the banks clear these stable coins between each other is actually a very interesting thing for me, and that's one of the areas that I think is still up for grabs in a way, how we're going to solve that problem, because banks today would have credit limits against each other, and they would have credit limits, of course, against the stable coins that the banks issue. But at some point, they will need to actually clear them because the stable coins are actually issued on the blockchain. So I still haven't worked that one through, but I'm happy if, Varun, you know how we solve that problem.
Yeah, it's a really interesting one. And I think there's a few different models. One of them is to settle in central bank money if the central banks can coordinate around the system. And the second one I've seen out there is an industry opportunity that's out there called Ubix, which is proposing essentially a clearing model, which is the parallel that is drawn is that it's similar to check clearing or travelers check clearing around the world, but essentially a system where you mutually recognize issuers of stablecoins and you're able to clear instantly with any of those recognized issuers. Interesting things certainly being developed.
Well, if nothing else, that's good for foreign exchange. It's always good to get some fresh ideas and, fresh momentum into the space. So we have 1 or 2 minutes because we can run over a minute or two if we want to, but just a last kind of closing sort of thought from both of you, please, on what you think is going to be the sort of next 12 months, big themes, the next steps, and what you'll be keeping an eye on. Cass, do you want to go first?
Yeah, I mean, I'm going to draw on the fact that the Circle IPO recently was just so successful and has really gone beyond initial expectations. Obviously, they launched I mean, it was just this month, and they hit a high of $250, and I think the share price is now around $180. It kind of gives me a sense that the traditional finance market is looking at this, thinking, how do we get exposure to the growth opportunities within this realm? So I would expect every bank is looking in the space. The Genius Act, I'm sure, will pass through the next round of voting. Not going to say when, because it's never worth trying to guess what regulators do, but I think it will pass at some stage this year, which will then allow banks to become a little bit more creative. And I would say, using Circle as a benchmark, we're going to see more building in the space, and that will unlock different kind of pools of liquidity, and that will and anything like that creates opportunities. And what more than anything that signifies to me is that the traditional finance market is really leaning in to the development in the blockchain space in a way they haven't been able to before, and that will be a positive even for the crypto underlyings.
Varun?
Yeah, building on that, I think US regulations, Genius Act, and so on is really pushing US issuers, US banks to enter the space at speed. And we've seen the real change momentum in the last 6 months. Conversations no longer about why, but how fast. We're also interestingly seeing that momentum carry around the world, not least because regulators feel the need to keep up and change their stance based on an old perception of blockchains and stablecoins. But also global banks are saying, well, if they can do it, why can't we in our home jurisdiction? And so it's really pushing the narrative everywhere. As a result, I think we'll see a proliferation of stablecoins. I think we'll see some banks issuing tokenized deposits, just like the JP Morgan dollar around the world as well. And I think as those two things develop and gain traction, we will see increased opportunities for this, solving some of the frictions we will have created in the system. So just to quickly touch on that, we talked about one blockchain really in this conversation, but there are really many, and each of those presents a fragmentation of liquidity. So interoperability between blockchains becomes very important. And as all these different tokens and different currencies emerge, the FX opportunity sits pretty very much.
Well, thank you both really ever so much. I think it was a super interesting discussion. Hopefully the audience will feel the same way. And the conversation was recorded, so we'll be putting it on LinkedIn and various socials. So please feel free to share it to your colleagues. Thank you, Cass. Thank you, Varun. And hopefully we'll speak again soon.
Thank you for having me.
Thanks, guys.